Hello, savvy investors. Today we're diving deep into the world of investments, specifically looking at ETFs versus mutual funds. These two popular investment vehicles often leave people scratching their heads, wondering which one reigns supreme. Don't worry, by the end of this video, you'll have the knowledge to confidently choose the right investment for your needs. We'll break down the complexities, explore the pros and cons, and equip you to make informed decisions for your financial future. Let's start with mutual funds. Imagine a basket, but instead of fruit, it's filled with a variety of stocks, bonds, or other assets. That's essentially what a mutual fund is, a basket of investments managed by professionals. When you invest in a mutual fund, you're buying a piece of that basket, giving you instant diversification. It's like having a personal chef who curates a delicious meal for you, taking the guesswork out of picking individual ingredients. You see, with mutual funds, you're pooling your money with other investors, and a fund manager takes the reins, making investment decisions on your behalf. They aim to achieve the fund's objective, whether it's growth, income generation, or a combination of both. Think of them as the experienced captains steering the ship towards your financial goals. But remember, just like any captain, their expertise comes at a price. Mutual funds typically charge fees for their management services, which can eat into your returns over time. Now, mutual funds aren't all created equal. There are actively managed funds where the manager actively buys and sells assets, aiming to outperform the market. Then there are passively managed funds, which track a specific market index, like the S&P 500. These funds aim to match the market's performance rather than beat it. And that's the gist of mutual funds. A convenient way to diversify your investments, but with fees that can add up over time. Now let's shift gears and explore the world of exchange-traded funds, or ETFs. These bad boys are like the cool younger sibling of mutual funds, bringing a modern twist to the investment game. ETFs also offer diversification by holding a basket of assets. But here's where the magic happens. They trade on stock exchanges just like individual stocks. Imagine walking into a stock market, but instead of buying shares of Apple or Tesla, you're buying shares of an entire industry, like technology or healthcare. That's the power of ETFs. They give you the flexibility to buy and sell your investments throughout the trading day, just like stocks. This intraday trading capability sets them apart from mutual funds, which are typically priced and traded only once a day after the market closes. And here's the cherry on top. ETFs tend to have lower expense ratios compared to mutual funds. Because they're often passively managed, tracking a specific market index, they don't require the same level of active management as some mutual funds. This translates into potential cost savings for you, which can make a significant difference in your long-term returns. So, ETFs offer the benefits of diversification, intraday trading flexibility, and generally lower costs. They're like the Swiss Army knife of investments, providing a versatile tool for investors of all levels. All right, now that we've covered the basics of both ETFs and mutual funds, let's put them head-to-head and highlight the key differences. Think of it as a boxing match, with each investment vehicle vying for a spot in your portfolio. In the blue corner, we have mutual funds, the seasoned veteran with a long track record. They come in various flavors, from actively managed to passively managed, catering to different risk appetites and investment goals. In the red corner, we have ETFs, the agile contender known for their flexibility and cost-effectiveness. They've gained immense popularity in recent years, attracting investors seeking a more hands-on approach to their portfolios. Now let's talk about costs. Mutual funds typically charge higher expense ratios than ETFs. These fees cover the costs of managing the fund, paying the fund manager, and other administrative expenses. While these fees might seem small, they can compound over time, eating into your potential returns. ETFs, on the other hand, often have lower expense ratios because they're passively managed, tracking a specific index. This means lower costs for you, potentially leading to higher returns over the long run. Another key difference lies in their trading flexibility. Mutual funds are typically priced and traded only once a day, after the market closes. This means you can place an order to buy or sell shares, but the transaction won't be executed until the next day at the net asset value, NAV. ETFs, however, trade on stock exchanges throughout the day, just like individual stocks. This intraday trading capability gives you more control over your investments, allowing you to buy or sell shares instantly at the prevailing market price. Now let's dive into a debate that's been raging in the investment world: passive investing versus active investing. It's like the age-old battle of Coke versus Pepsi, but instead of sugary drinks, we're talking about investment strategies. Passive investing involves tracking a specific market index, like the S&P 500, with the goal of matching the market's performance. It's like cruising down the highway in cruise control, letting the market's momentum carry you forward. Active investing, on the other hand, involves a fund manager actively buying and selling assets, aiming to outperform the market. It's like driving a sports car, constantly shifting gears and making adjustments to try and stay ahead of the pack. Now you might be thinking, why settle for average market returns when I can shoot for the stars with active management? Well, here's the catch. Studies have consistently shown that passive investing tends to outperform active investing over the long run. One of the main reasons is fees. Remember those pesky expense ratios we talked about? They can take a bigger bite out of your returns with actively managed funds. Active managers also face the challenge of consistently making winning trades. Even the most seasoned professionals can struggle to beat the market year after year. It's like trying to time the waves in the ocean. You might catch a few good ones, but it's nearly impossible to be right all the time. Passive investing, with its lower costs and disciplined approach, has historically proven to be a more reliable way to build wealth over time. Let's talk about money, or rather, the money that mutual funds can cost you. While mutual funds offer a convenient way to invest in the markets, it's crucial to be aware of the fees associated with them. These fees can vary depending on the fund, but they can definitely impact your overall returns over the long haul. One of the main fees you'll encounter is the expense ratio. Think of it as the annual fee you pay for the fund's operating expenses. It covers things like the fund manager's salary, administrative costs, and marketing expenses. The expense ratio is expressed as a percentage of your assets in the fund. For example, if a mutual fund has an expense ratio of 1%, it means that you'll pay $1 in fees for every $100 you have invested. Another fee you might come across is the load fee. This is a one-time fee charged when you buy or sell shares of a mutual fund. Load fees can be front-end loads, meaning you pay the fee upfront when you purchase shares, or back-end loads, meaning you pay the fee when you sell your shares. These fees can range from a few percent to as high as 8.5%, so it's essential to factor them in when evaluating the cost of investing in a mutual fund. Now you might be thinking, are these fees really that big of a deal? Well, let me tell you, they can make a significant difference in your long-term returns, especially if you're investing for retirement or other long-term goals. Over time, even small differences in fees can compound and eat into your potential profits. Let's face it, not everyone has thousands of dollars lying around to invest in the stock market. But that doesn't mean you have to miss out on the opportunity to grow your wealth. Fractional shares have revolutionized the investing game, making it accessible to investors of all budget sizes. Think of it like buying a slice of pizza instead of the whole pie. With fractional shares, you can buy a portion of a single share of stock or ETF, allowing you to invest in companies with high share prices, even if you have a limited budget. Let's say you've got your eye on a company like Amazon, but their stock is trading at over $3,000 per share. That's a hefty chunk of change for a single stock. But with fractional shares, you can buy a fraction of an Amazon share, say $100 worth, and still participate in their growth potential. This opens up a world of possibilities for investors, especially beginners or those with limited capital. You can diversify your portfolio across a range of assets, regardless of their share price. Now, not all brokers offer fractional shares, so it's essential to do your research and find one that aligns with your investment needs. But the bottom line is that fractional shares have democratized investing, making it accessible to anyone who wants to build wealth, regardless of their budget. So, whether you have $100 or $10,000 to invest, fractional shares empower you to take control of your financial future. When it comes to investing, it's natural to want peace of mind knowing your hard-earned money is in safe hands. The good news is that both ETFs and mutual funds are subject to regulations designed to protect investors, like you, from fraudulent activities and ensure fair practices in the financial markets. In the United States, the primary regulatory body overseeing both ETFs and mutual funds is the Securities and Exchange Commission, SEC. They've established rules and guidelines that these investment vehicles must adhere to, safeguarding investors' interests. One of the key regulations is the Investment Company Act of 1940, which provides a comprehensive framework for regulating mutual funds. This act mandates that mutual funds register with the SEC, maintain certain levels of liquidity, and adhere to strict guidelines regarding their operations and disclosures. Similarly, ETFs, while structured differently from mutual funds, are also subject to SEC regulations. They must register under the Securities Act of 1933 and comply with various rules related to trading, disclosure, and investor protection. The SEC's oversight aims to promote transparency, fairness, and investor confidence in the ETF and mutual fund industries. They conduct regular examinations of fund companies, review fund prospectuses, and investigate any potential violations of securities laws. So we've reached the million-dollar question: should you invest in ETFs or mutual funds? The truth is, there's no one-size-fits-all answer. The best choice for you depends on your individual financial goals, risk tolerance, and investment style. Think of it like choosing between a delicious plate of pasta and a flavorful sushi platter. Both can be incredibly satisfying, but it all boils down to your personal preference and dietary needs. If you're looking for a cost-effective way to track a specific market index, such as the S&P 500 or the NASDAQ 100, ETFs might be the way to go. Their typically lower expense ratios can translate into higher returns over the long run, especially if you're investing for retirement or other long-term goals. Plus, their intraday trading flexibility gives you more control over your investments. On the other hand, if you prefer a more hands-off approach and value the expertise of a professional fund manager, mutual funds might be a better fit. Actively managed mutual funds aim to outperform the market, although they typically come with higher fees. Ultimately, the key is to do your research, understand the differences between ETFs and mutual funds, and choose the investment vehicle that aligns best with your financial goals and risk tolerance. That's it for ETFs and mutual funds. We've explored the differences between these two popular investment vehicles, from their structure and costs to their investment strategies and regulatory environment. Remember, the best choice for you depends on your individual financial goals, risk tolerance, and investment style. Whether you're a seasoned investor or just starting out, I hope this video has empowered you with the knowledge to make informed decisions about your investment portfolio. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more finance tips. And don't forget to share this video with your friends who are also looking to navigate the exciting world of investing. Keep investing smartly and see you in the next video.